In 2021, a single truck could pull high rates on the spot market, turning owner-operators into temporary millionaires as brokers fought for their attention. By early 2026, those same truck stops had gone deathly quiet, holding rows of repossessed rigs that turned a period of independence into a masterclass in bankruptcy. Everyone blamed the economy, pointing to a sudden, unpredictable crash. But if you look at the industry's own gospel of grind and grit, that constant noise about simply outworking the cycle, the math tells a different story. The disaster wasn't a sudden event that caught anyone off guard. It was a multi-year slow bleed that the industry's favorite success stories were actively hiding in plain sight. It is easy to look at the headlines from this spring and assume the carnage in the trucking industry arrived overnight. You might see the empty lanes or the influx of auction listings and think that this is a sudden freak event. But the reality is that the foundation of this crisis was poured back in 2021. Back then, demand was so high that dry van spot loads surged to $4 per mile, or sometimes even more. It was a gold rush that pulled thousands of new owner-operators into the market, many of whom took on massive equipment loans at the absolute peak of pricing. Then came the cliff. In mid-2022, the freight boom abruptly stalled, shifting the industry into a prolonged, punishing recession that most people simply tried to outrun. For years, operators burned through their cash reserves, waiting for the surge they were promised. They held on, kept the engines running, and hoped that the market would revert to its previous highs. Instead, the industry settled into a stagnant baseline of excess capacity and eroded margins. Every month of that long slog made the math harder to justify. By the time 2026 arrived, carrier exits were already running significantly higher than they were this time last year. The system was already hollowed out long before the final accounting began. The ice was about to make the decision for them. The problem wasn't just the market. It was the culture that told every operator that grinding harder was the only way to beat the cycle. You hear it at every truck stop and on every industry forum. Just weather the storm. Wait for the market to flip. If you endure enough bad months, you will eventually be rewarded for your persistence. This narrative became the most dangerous liability on the balance sheet. It sold the industry on the idea that survival was a badge of honor, a test of pure grit that separated the real truckers from the amateurs. But here's the reality that the spreadsheet keeps hidden. Grit does not pay for fuel, and determination does not cover an insurance premium that has doubled since the pandemic. In 2026, the carriers who were forced out were not necessarily the ones who worked the fewest hours. They were the ones who treated their business like a lifestyle they had to fight to keep, rather than a mathematical equation that had to balance. When you view a freight recession as a storm to weather, you start dipping into savings you cannot replace. You start financing equipment at the peak of a market cycle, convinced that the high rates will last long enough to pay off the debt. You end up chasing a promise that was already broken in mid-2022. Survival is a matter of liquidity, and when your cash reserves hit zero, the myth of enduring the storm evaporates. Most operators never thought about the market from the broker's side of the table. But brokers and shippers are optimization machines, and the logic they run on is simple. If a carrier cannot name a floor, they do not have one. When a small owner-operator picks up the phone and accepts whatever rate is offered rather than walking away, they are broadcasting something the counterparty immediately registers. They are signaling that their capacity is a commodity with no reserve price. In a market flooded with trucks and starved of loads, that signal is an invitation to compress rates to the lowest number a desperate driver will accept. This is where the broker perspective becomes a mirror. From that side of the negotiation, an operator without a visible cost floor is not a business partner. They are a resource to be cleared. Rate-setting behavior in the spot market was shaped in part by this pattern repeating across thousands of daily transactions. When enough carriers accept below-cost freight just to keep the wheels turning, they collectively set a new market expectation, one that drags down even the operators who do know their numbers. The floor of the entire market gets redefined by the most vulnerable participants in it. The shipper wins that transaction every time. The carrier absorbs the loss, and the rate signal that gets recorded in the data looks to an outside observer like a legitimate market price. Understanding who was actually setting those numbers and why changes the entire picture of what the recovery data meant. And that distinction matters more than most people realized. The answer is that by early 2026, the industry was drowning in a storm of contradictory signals. Some analysts looked at the numbers and saw a market shift toward inflationary territory. They pointed to all-in rates reaching a 3-year high, suggesting to many observers that the long-awaited rebound was finally taking hold. It was easy to believe that the worst was behind us. In fact, by April of that year, spot rates had clawed back a notable percentage from their November lows. If you were sitting in the cab of an aging truck, trying to decide whether to pay for a transmission fix or park the rig for good, those numbers look like a lifeline. You might have seen the rising rate and thought that if you could just hold on for one more quarter, your margins would stabilize. But those recovery metrics were a trap. They measured surface-level fluctuations in the spot market while ignoring the decimated state of carrier liquidity. A brief uptick in rates looks like a trend when you're staring at a screen, but for an operator whose cash reserves have been bled dry by years of inflation and debt service, it is nothing more than a statistical mirage. The rising rates were a reaction to a massive reduction in truck availability, not a surge in healthy business demand. It was a classic case of the market contracting precisely when the operators were at their most vulnerable. The trap worked perfectly because it felt like a beginning, when in reality, it was just the final shakeout. The problem wasn't just the freight rates. It was the crushing weight of the machinery parked in the yard. During the previous industry boom, thousands of owner-operators financed brand-new trucks at premium prices, gambling that the multi-dollar-a-mile era would last long enough to turn a profit. They signed contracts at the peak of the market, but they built their business plans on the assumption of unending growth. When the recession took hold in 2022, those fixed debt obligations didn't vanish or adjust to lower income levels. They stayed exactly the same while insurance premiums climbed to record heights. Every day an operator sat waiting for a load, that debt interest compounded, and cash reserves that were already thin began to evaporate. An owner-operator with a high monthly note on a truck they bought for thousands over sticker price is in a losing race against time. If the truck isn't moving, it is literally eating the owner alive from the inside out. By 2026, the debt they took on to succeed in a bull market became the primary driver of their failure in the bear market. The high cost of that equipment left zero room for error, and any minor mechanical breakdown or missed payout became the final nail in the coffin. When the rate drops below the cost, the truck is already dead. By April 2026, the slow bleed turned into a full-scale hemorrhage. The numbers coming out of the industry were no longer just about tight margins or unlucky dispatchers. They signaled a collapse that was mathematically unavoidable. In the span of just 30 days leading up to that month, more than 20 major trucking and logistics companies filed for bankruptcy. This was a clear sign that the capital reserves had finally hit absolute zero. The scale of the washout was historic. Official data showed that carrier exits were running significantly higher than the same period the year before. What makes this so shocking is not that companies failed, but that so many were wiped out after fighting for years to hold on to their operations. These were businesses that had survived the initial 2022 freight collapse, yet they could not overcome the compound interest of their equipment loans and the persistent gap between spot rates and operational costs. When the market finally turned against them, they realized they had been holding on to debt, not assets. This wasn't merely a case of individual managers making mistakes or drivers being unable to find consistent loads. It was the result of a systemic inability to bridge the gap between fixed peak-era debt payments and an anemic modern freight environment. When the rate drops below the cost, the truck is already dead. The path ahead was now defined entirely by the wreckage left behind. Once the false signal of early 2026 had been exposed by a fresh wave of carrier exits, the operators who remained made a decisive behavioral shift. They stopped treating incoming rate data as a directional indicator and started treating their own cost structure as the only number that mattered. The spot market could climb or collapse on any given week that was now understood as noise. What they could control was whether a given load crossed the threshold of full operational cost coverage before the truck left the dock. This discipline became the defining trait of the survivors. Where the previous generation of operators filtered loads primarily by distance or relationship, the carriers still standing in the wake of the shakeout built rigid internal filters anchored to a cost floor. Every load offer got measured against fixed overhead, insurance obligations, and debt service before any decision was made. Loads that did not clear that line were declined, not reluctantly, but systematically as a matter of policy rather than preference. The behavioral consequence was a smaller, more selective operational footprint. Survivors ran fewer miles and accepted fewer loads than their boom-era counterparts had. But the loads they did run were mathematically guaranteed to sustain them rather than slowly drain them. The lesson absorbed from watching peers chase a rising rate curve straight into insolvency was not complicated. Volume without margin is just an accelerated path to the same exit. What remains to be seen is whether this hard-won discipline can survive the next cycle of optimism, or whether the market will find new ways to erode it. The reality is that the market is not a hurricane you outlast with sheer stubbornness, but a cold engine that either runs on thin margins or grinds to a halt. You now know the precise math behind the cost floor, which means you will never again mistake a headline about rising spot rates for proof of a total recovery. By subscribing, you gain access to the data-driven frameworks needed to insulate your operations before the next shift in capacity forces another wave of market exits.